Please consider our plight. Stop the rate cuts. That's the message from a group representing Australians over 50 that's pleading for the Reserve Bank to halt constant interest rate cuts, saying self-funded retirees are being forgotten in the RBA's decision-making. The cash rate was lowered to a record low of 2% yesterday. And the FiftyUp Club has surveyed more than 13,000 people, saying nearly 60% of them are suffering because of lower interest rates on their savings products. Christopher Zinn is spokesperson for the FiftyUp Club. He joins us now. Good morning.
Yes, good morning, Glenn.
First of all, who is the FiftyUp Club? How many people do you represent?
Well, we've got 120,000 members, and this is a kind of a consumer club, but essentially we look at incomes too, so it's not just spending, although we try and direct people how to save money with electricity and those kind of issues, but it's also for the 50 up, which of course are the boomers getting older. There's a whole lot of issues around jobs, job discrimination, pensions, superannuation, which are all very much involved in the budget and discussions now, but we think that they need to, if we can group their voices together, hopefully we can get some change that benefits them.
All right, you mentioned savings. They must be getting a bit harder. 10 rate cuts since November 2011. What's been the effect of those cuts in real terms on the people you represent?
Well, look, quite deleterious, and we've seen those rates drop from 5 or 6% to 2% in terms of the cash rate, but we know that the banks pass on the reductions in what they'll pay for deposits even faster than sometimes they do with home loans. So look, it's had a big impact, and as well as 13,000 people responding to the survey, we had many hundreds of comments, and one guy in Bondi, he saw his income from savings accounts fall from 20,000 to about 7,500. So look, these are people who say that they've done the right thing. They're prepared to be self-funded. Some of them are on part pensions as well. After the GFC, they've particularly gone to safer products like term deposits. And essentially, they've just found it really dry up. And I think they're saying to the RBA, while there's good reasons of monetary policy to bring down the cash rate, they really suffer. And to see the papers and the media are always full of people cheering and saying how fantastic it is, including the politicians, that does stick in their craw.
Obviously eroding the value of their retirement incomes. A big difference to go from, say, $20,000 a year to $7,500 a year. It makes it a bit difficult to live on. Are people actually feeling actively penalised or victimised?
I think that they are feeling aghast because, as the Glenn Stevens said last week, the RBA governor, that it's a bad time to retire. You're worse off than you were people a decade ago because of these low returns on safe investments. But what options do you have? You really need to. He suggests that they have to seek out riskier investments. So that means moving beyond bank deposits. But of course, for that you need financial advice, and that opens a whole other can of worms in terms of how you access financial advice that you can really trust, and we know that's an ongoing issue. So they are caught between a rock and a hard place. Not all of them, of course. There are some self-funded retirees who are into property and very financially savvy, but look, there's 1.9 million people who are in this group of part pension and self-funded, and some of them will go to what they see as the safest and most reliable way of saving, and that really is the one that is paying the least, as of today, very low rates.
The Commonwealth Bank is not passing on the full mortgage cut, but instead saying it'll increase the rates on one of its term deposits, obviously looking to cash in a bit here to attract some of those customers with a bit of an opportunist move. But is it hard, obviously, to change, given that by definition these are locked-in term deposits?
Yeah, although some of them can just be for 3 months or 1 month, they're short-term. So I think that's great. If we can get more competition in that deposit savings space, it's terrific. But needless to say, there's still been a real reduction, and who knows when they're going to go up by any substantial amount. So many people are looking and deciding, well, what do we actually do? And as I've said, the issue is who do you go to? Who do you ask? How do you find that out if you don't have the financial nous yourself?
What do you say to those that say it's a bit of a trade-off, that there's also a benefit for these people because the economy will be stronger overall as a result of the cuts? Yes,
I noticed some of the self-funded group saying that, and look, that is true to an extent, but I think all of us are far more aware of what we get directly as opposed to more amorphous gains in the economy, which might not be so evenly spread. So I think you trust on what you can see, not on what people suggest might come down the track. And as we found, even with the RBA cuts, have admitted that in fact they don't have the stimulus that's been expected, which came in the past.
Some analysts are concerned that these ultra-low rates will destabilise the financial sector. It'll encourage self-funded retirees to seek higher returns through the riskier investments rather, but people worrying about being being addressed by the Reserve Bank, as you cited yourself, that you heard Glenn Stevens only recently suggest that this was an issue and suggested that they might have to look at some of these alternative investments. So he's very aware of that, but he's cut regardless. So you're not forgotten, you're just being willfully ignored.
Yes, well, look, I suppose it's always good to remind those, and while Glenn Stevens thankfully isn't a politician, we send this, so we take this survey to the politicians and the Reserve Bank afterwards so they can, we hope there's a little tap on the shoulder does help from time to time. I know Glenn Stevens has to consider the whole economy, but, people who are 50 up are an increasing, because of the baby boomers coming through this area, they're increasing, they represent 50% of domestic spending. They're an important group. We believe that they shouldn't be totally overlooked.
Treasurer Joe Hockey wants Australians to take advantage of the cheap credit to spend up big. I suppose the people you represent will be spending less, not more.
Yeah, look, exactly. Look, some of them are very well off, and of course this group have benefited from asset appreciation over the years, so some of them are sitting very pretty, but not all. And again, it was very interesting, and I'd invite people to do that. Go to 50upclub.com.au. Look at some of those comments, hundreds of them from all sorts of people, some doing it very tough. Often the question they ask is, we thought we've done what was right to provide for ourselves into our retirement, but basically we find ourselves, one, being forgotten, and two, really getting the short end of the deal, because in fact what we've invested in, they just don't feel their certainty, and that lack of certainty is amplified by discussions of changes to pension assets tests and also to superannuation being needed, albeit that aimed at richer superannuation, but they also ask, well, when is that going to stop?
They certainly do seem to be in the gun at the moment. Christopher Zinn, thank you.
Thank you.
Spokesperson for the 50 Up Club, saying not everybody's happy with the way interest rates are going.